Have you ever thought about getting a loan to pay off your credit cards? Today we're breaking down credit card loans and personal loans so you can decide if it's right for you. We'll look at how they work, who benefits, and what to watch out for. Let's start with credit cards. It's no secret that Americans love to use credit cards. In fact, the average household carries a credit card balance of nearly $6,000, and with good reason. Credit cards are easy to use and offer rewards like cash back or points that can be redeemed for free travel or merchandise. Plus, they help you build credit, which is important for things like buying a home or getting an auto loan. The problem is that many people carry credit card debt from month to month, which can quickly become a slippery slope. That's because credit card interest rates are very high. The average rate in 2022 was between 20 and 27% annually. To make matters worse, credit card companies make it difficult to pay off your balance. Even if you make more than the minimum payment, a large chunk of your payment goes toward interest instead of the principal balance. This means that your debt can easily compound, especially if you continue to use your card while paying it off. Now let's take a look at personal loans. Unlike credit cards, personal loans are not revolving. That means you receive a lump sum of money up front, and then you have a set amount of time to pay it back. Personal loans typically have lower APRs than credit cards, making them a better option for borrowers who want to pay off their credit card debt and save on interest. They also offer more flexibility when it comes to repayment terms. Personal loans can be paid off over several years, which makes them a good option for borrowers who need more time to repay their debt. Here's how it works. First, calculate the total amount of money you owe on your credit cards. Then you'll want to compare the APR and term of a personal loan to see if it's lower than what you're currently paying on your credit cards. Be sure to check for fees. Origination fees are common, but some lenders charge other fees too. Once you find a loan that meets your needs, you'll need to submit an application and provide documentation such as your income and credit history. If you're approved, the lender will send you the funds, which you can then use to pay off your credit cards. Here are some key steps to take before applying. Improve your credit score. A higher score means you are more likely to be approved for a loan and get a lower interest rate. Pre-qualify with multiple lenders. Many lenders will perform a soft check, which doesn't affect your credit score. This allows you to compare offers from different lenders without hurting your credit. Don't apply for new credit cards. While paying off your credit cards, you don't want to add more debt. This can lower your credit score and make it more difficult to qualify for a loan. It may seem too good to be true, and there are risks to consider. While personal loans can be a great way to pay off credit card debt, they do come with some risks. For example, if you miss payments, your credit score will suffer. Additionally, if you take out a loan for a longer term, you may end up paying more total interest. And as we mentioned, some loans have origination fees, which can add hundreds of dollars to the cost of borrowing. That said, if you're able to stay on top of your payments, a personal loan can be a great way to get your finances back on track. To avoid missing payments, automate your payments by setting up autopay or by using a payment service. You can also use the debt snowball or avalanche method to pay off your loan faster. The debt snowball method involves making minimum payments on all of your debts and then putting any extra money toward the loan with the smallest balance. The debt avalanche method, on the other hand, involves making minimum payments on all of your debts and then putting any extra money toward the loan with the highest interest rate. Before you go, here are some additional tips. Try negotiating a lower APR on your credit card. Call your credit card company and ask for a lower APR. If you have a good credit score and payment history, they may be willing to lower your rate, saving you money on interest charges. Consider balance transfers. If you have good credit, you may be able to transfer your balance to a credit card with a lower interest rate. Just be sure to read the fine print and avoid balance transfer fees. Now that you know the ins and outs of credit card loans and personal loans, it's time to decide if it's right for you. If you're struggling to pay off your credit card debt, a personal loan may be a good option. You'll have a clear payoff plan, fewer bills to pay, and potentially save money on interest. Just be sure to shop around and compare offers from different lenders before applying. And always remember, knowledge is power. The more you know about personal loans, the better equipped you'll be to make a smart decision. So keep learning and stay in control of your financial future.